Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Financial planning services through Andover Advisory Group, a registered investment advisor. Cambridge and Andover Advisory Group are not affiliated. Cambridge does not offer tax or legal advice.
Good morning, Justin. I want to thank you for your hard work. The information is a big help, and I appreciate what you did. Enjoy the show.
All right. Thank you.
Okay, that's great to know. Thank you for the information.
You're very welcome.
Okay, Justin.
Okay.
Thank you very much.
You're very welcome.
You're right on the money there, Jeff. How are you doing this morning? Thank you.
Well, those are good questions. Hopefully that helps.
Yes, thank you so much.
You're very welcome. You're going to hear stuff here that you don't hear anywhere else on radio.
And don't forget it.
Edition of the Talk Money Show. Thank you for joining us. If this is your first visit, allow me to introduce myself. My name is Jeffrey Shank. I'm the owner of Andover Advisory Group, a registered investment advisor. It's founded in 1996, based on the premise that everyone needs a sound financial plan in order to reach their personal financial goals. And we do the show here weekly to help you in that endeavor. And ultimately, our goal is to improve your money IQ. So if you have a question, we'd love to hear from you. You can do that in several ways. You can send us a message right on Facebook. You can send me an email. It's jeff@talkmoneyradio.com, or give us a call. We'd be glad to hear from you. It's 877-475-2062. Good morning, Lou. How are you this morning?
Doing very well. I want to do what we were talking about this morning. Get me interested.
Student loans?
Yeah. Do that now.
I was thinking about doing it, but I think we might have to. It's just so there's so much to discuss. I don't think we could do justice in this little time we have on Monday mornings.
Yep.
And so I'm thinking maybe we'll have some sort of a webinar later on.
I like it.
And invite everybody to join us at a convenient time. We can talk about student loans. But hey, it's almost the end of March. In fact, today's March 29th. 2021, and when is opening day for the Red Sox?
Thursday, April 1st.
And that's at Fenway, or that's just opening day for baseball in general?
They're at Fenway, I believe.
Is that right?
Against the Orioles, yeah.
I see. Hey, I have a client that actually pitched in the major leagues, and
really
years ago, and he said he was looking at the Red Sox,
mm-hmm.
and he
Laughing?
liked what. No, he said
liked what he said?
No, he said he liked what he saw, and I'm no expert, so I figured I'd ask you. Do you concur?
They're okay. They're not a contender.
He didn't say that they were going to finish, in first place, but he did like.
They're not a contender. I have problems with the pitching. I think the lineup's pretty good.
Yeah,
but I think the pitching is a hot mess.
Yeah, he actually lives in Arizona now. I moved from Massachusetts to Arizona, so
really,
yeah, he's been there for 10 years now. And still
gonna tell me, or gonna tell me?
No,
Okay,
you don't know. No. You would not know him. You definitely would not know him.
He pitched in the majors, and I wouldn't know him.
No, you wouldn't know him.
Okay.
Yeah, it was short. I don't even know how long.
All right.
How long it was.
Well, we'll test that out at some
point. Hey, so I wanted to give everybody today an update on tax filing, because there's some things that have developed since we were on the show last. And also, I get this question a lot. Should we file jointly or separately? And so I wanted to give you 5 reasons why you might want to consider, if you're married,
mm-hmm.
filing separately instead of jointly.
Oh, interesting. I like it.
And the most recent stimulus bill, now actually signed into law, is creating a lot of planning opportunities. And I'm going to focus today a little bit on the child tax credits. But let's just start with the update for the 2020 tax filing season. I said a couple weeks ago that there was some pressure to delay the due date for your 2020 tax return. And
Yes.
in fact, they extended it 1 month, and that would be May 15th. But of course, May 15th is a Saturday, so it actually got moved to Monday, May 17th.
States as well.
So initially, there was no information available about the states. They had to figure out what they were going to do. But in fact, the state of Massachusetts, anyway, did conform. And now, so for Massachusetts residents, anyway, your filing due date is the same for federal as it is for the state. So May 17th for both. But that is for individual returns only. So just for individuals. So your fiduciary returns or your corporate return is still due April 15th.
Oh, I see.
They
Okay.
haven't changed that yet.
Mhm.
There might be some additional pressure to move that, but that's only a couple weeks away. So if you have to file a return for a trust or an estate, somebody passed away, you're the executive of the estate, or you are self-employed and you have a corporate return that is due, even an S-corp, you still have to meet that April 15th deadline unless you file for an
was gonna
extension,
say,
which
yeah.
actually might be a good idea because especially if you're self-employed, that corporate return sometimes goes hand in hand with your personal return.
Right.
So you might want to extend the due date there, and that which would be, by the way, for a so that'd be October 15th would be. So they are not extending the extended due date.
extension.
The next right.
But I haven't got much room there.
So it would still be October 15th. So the good news about that is if you owe a balance, it would have to have been paid by April 15th, the original due date. Otherwise, you'd incur additional penalties for not getting it in on time. So that payment you can now make on May 17th without any additional penalties. So if you owed interest because you owed so much,
Right.
that's not going to change, but it's not going to increase because you're filing on May 17th instead of April 15th. And another, I think, very important thing to know is that the new stimulus law. What are they calling that thing? I had it. I made a note of it. Was it the American? It's not the recovery, not the rescue. There is a. They're not giving it an acronym just yet, but they did give it a name, of course. But there was a provision in there.
Is there a guy who's in charge of the acronyms?
I think there is a department.
Is there a department of
I think there's a
acronyms?
department, yeah, it's 3 people.
Because they really work hard. There's some real stretches in some of these things.
So one important provision of this new law is that the first $10,200.
The American Rescue Plan Act of 2020.
Yeah, that's what I thought. American Rescue Plan. Yeah, that's it. American Rescue Plan. ARP.
No.
ARPA.
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 Yeah.
The first $10,200 of unemployment benefits is now exempt from income tax. And so we were wondering how they were going to handle that.
Yeah.
Because a lot of folks already filed their income tax return. So we have some good news there. The IRS is going to make the adjustment for you. You do not have to file an amended
An
return.
automatic adjustment. Wow.
They will automatically exempt the first $10,200 of your, and probably send you a letter that says, you got your tax return. We processed it. We noticed that you included the first $10,200 of unemployment benefits as taxable income. And good news is it's going to be less. And so your tax is less. And if you ended up paying, you'll get a refund. If you were getting a refund, you'll have a larger refund.
Yep. But
you'll probably get some notice about that. And by the way, the the $1,400 stimulus payment that was included in this per person, including $1,400 per, right? Those payments have largely already been dispersed. So the IRS has been very busy sending out checks to everybody.
Yeah.
Direct deposits when they could, checks to people that they couldn't, and debit cards. So a reminder, if you get something in the mail that looks like it might be a credit card offer, it might just be your stimulus payment. So don't shred it.
When you say largely, how largely? Because I know people who haven't got their check, or at least claim they haven't.
So if they didn't get direct deposit, they're probably those went out last week.
These were direct deposit, but yeah.
So if it wasn't a direct deposit, if you're not eligible for a direct deposit, and there's a lot of reasons why you wouldn't be, then you're going to get either a check or a debit card. I don't know why they choose checks or debit. I mean, why wouldn't you just send a debit card to everybody? I'm not sure exactly why that is the case, but
because people are throwing them out.
And that's the reason why they would make a decision to send you a check instead of a debit card. I don't know. Yeah. I mean, they're making that decision in advance. They're not waiting for you to say, hey, send me a check, send me a debit card, right?
So all the direct deposits are out there, theoretically?
Theoretically. Yeah, the direct deposits have already been made. So they base it on your 2019 or your 2020 tax return in terms of eligibility. And so that would be a question of adjusted gross income, because they put a limit of $150,000 up to a max of $160,000, where if you exceeded that 160, you wouldn't be eligible for a payment. And they looked at the 2019 tax return or the 2020 tax return. And if you hadn't filed your 2020, they looked at the 2019. If your 2019 tax return showed a big capital gain for some reason because you sold a property or something like that, then you wouldn't be eligible for a payment. Now, you could file the 2020 tax return, likely ask them to send you an advance on your tax credit, because what this is all about is a tax credit.
Yeah.
It's a one-time tax credit that is available to all taxpayers. It is refundable. And if for some reason you don't get it, you claim it on your 2021 tax return. And if you
next April,
yeah, that's exactly right. But if you, I believe that there is where's my payment? I think that's the web URL that you use, and you can go there and check the status. And last time we did this last year, you were able to go in and tell them that, hey, I filed my 2020 tax return. You probably based it on 2019. Please send me my advanced tax credit. But be assured that if you are eligible to receive it, you didn't get it, you can claim it as a credit on your 2021 income tax return. Which actually brings up another subject, and that is, or actually a complication, I guess, for people who are separated and divorced and are filing separate income tax returns. That tax credit for the dependents is conditioned on you claiming those dependents on your 2019 or 2020 income tax return,
right,
which is creating a potential nightmare for separated and divorced parents.
Yeah. And this expanded to some older kids that might not have been claimed as dependents.
17 versus age 16. That's exactly right. So they go all the way up to age 17 now. And what that does is that creates a situation where, depending on which tax return has been filed, depending on which parent has claimed those children as dependents, will determine whether or not you get that advanced tax credit. Mm-hmm. But you might actually not be eligible for it when you file your income tax return. No guidance yet on whether or not you'll be able to keep that credit or have to pay it back.
Yeah, we'll figure that out later.
But if you are someone who let's say a couple, and this happens a lot. They alternate who's going to take the child as a dependent. Yeah, it happens a lot.
Does it?
Yeah, happens a lot. And so your 2021 might be your year, but they're basing the advanced tax credit on 2020, which your ex-spouse claimed a dependent.
Yep.
Potential nightmare for
It's a 2021 tax credit. It goes to the 2021 person.
But what if the person who wasn't eligible
Gets it in 2020?
gets it in 2020? Are they going to have to pay it back?
Yeah.
Good question. One more thing on the
I just did a Judge Judy right there. I just litigated that whole thing. The person who has 2020 as a dependent gets this
2021.
2021.
Yep. Right. Yeah. One more thing too. This delay, the extension of time to file to May 17th. So far, no guidance on whether or not that applies to the deadline for making your IRA contributions for 2020.
Oh, I see. Yeah.
So individual retirement account contributions typically are due. They have to be paid and contributed to the account by the due date of the return, April 15th. So even if you filed it in January or February, you'd still be able to make that payment as late as April 15th. Extending the due date doesn't extend the time that you have to contribute.
What did they do last year?
They extended the time to make the payment. My guess is that they'll do the same thing, but no, as of this morning anyway, no official guidance on that from the IRS. So you may want to, just to be on the safe side, if you're planning on making a contribution to your IRA individual retirement account, make it by April 15th until we get guidance.
Right.
And keep in mind that extending the due date doesn't extend the time to make that contribution for an individual retirement account. However, if you have a self-employed retirement account and you're making contributions, you can actually extend the time to make that payment by filing an extension. Again, don't know if that's going to also give you an additional time because they extended it to May 17th. Not sure at this point. Right. So to be on the safe side, if you're self-employed, you're planning on making a contribution and you're not going to make it by April 15th, file an extension of time to file your tax return, even though you have until May 17th. They're creating a lot of problems.
Yeah. It's a lot to keep track of.
A lot to keep track of. And then there's one more thing I wanted to mention as well, and that is the child tax credit under the American Rescue Plan is going to be increased in 2021 from $2,000 per child to $3,000 and $3,600 for qualifying children under the age of 6. Subject to a phase out. It's based on modified adjusted gross income, MAGI. And the legislation also makes 17-year-olds eligible as qualifying children in 2021 as well. So for most individuals, the credit is fully refundable for 2021 if it exceeds your tax liability.
Yeah,
fully refundable. Yeah. So you don't have no tax liability, you can still get the tax credit. And the IRS is setting up a online system that will allow you to claim that credit in advance. You can get up to 50% of the credit as similar to the Affordable Care Act, ACA, where you can get an advance on the credit, the health insurance credit to reduce your premiums. You can do the same thing with the child tax credit.
We are pretty damn close to firing up the helicopters, aren't we? We are damn close to just firing up the helicopters and dropping money.
Don't have to anymore. They just push a button and they direct deposit it to your bank account.
Yeah.
The modern helicopter.
Bernanke was right.
Yes. Yeah. And there is another change too regarding.
They were smart. They just direct deposit these and they just create a Robinhood account for everybody and just direct deposit it in there.
Put it right in there.
Yeah.
Well, you can connect your Robinhood account. I know you're just kidding, but
yeah.
So the child independent tax care, child independent care tax credit.
Yes.
So it's a tax credit for the cost of childcare. So for 2021, the legislation increases the maximum credit up to $4,000 for one qualifying individual and up to $8,000 for two or more. So that is a substantial increase, and that's available to folks who it is income means tested. So if your modified adjusted gross income exceeds a certain level, then they start to scale it back until it disappears altogether. But that's something else to keep in mind. And again, for separated and divorced parents, this is going to get to be a very complex situation.
What if they share the cost of daycare?
That's a great question.
Yeah,
I don't know the answer.
Yeah,
I don't know the answer. One of the other parent might have to claim the credit. And so how?
And then divvy it up themselves.
Yeah.
That'll be great.
Yeah. And it's fully refundable for 2021 if it exceeds your tax liability again. Mm-hmm. So, to your point, though, there's the bottom line is they're using the tax code as a way to redistribute. Well, that's the bottom line.
How about dog daycare? Does my dog qualify?
No, your dog does not qualify.
Damn.
No.
It's going to be a business expense, though.
Hey, so I want to take a few minutes today and talk about married filing separately and 5 reasons why you would want to file separately. Typically, it's financially speaking, it's better to file jointly, but in certain circumstances, it does make sense to file separately, and I got 5 reasons why that might be the case. So we're going to take a quick break, and when we come back, we're going to discuss those 5 reasons. Please stay tuned.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Welcome back. So we had a question about what's deductible. What you can deduct as a business expense?
We had a question. That's right. We had a question.
And those we were doing it every year. I think in the last couple of years, I don't think we did it. Where the most outlandish tax deduction.
Oh, that's going to come back.
Deductions.
Yeah.
I think we're going to put that one in that.
It's not outlandish at all. It's not outlandish at all.
So you're asking if you have to put you have to hire somebody to take care of your pet so that you can do your job.
Yes.
Is that tax deductible?
Because I'm working from home.
Is it a deductible business expense, not an itemized deduction?
Not an itemized
deductible business expense, right?
Yep.
I think you're gonna have a hard time.
All right.
I think you're gonna. hard time justifying that one. Low. I could be wrong. Hey, so again, I get asked this question a lot. Should we consider filing separately instead of jointly? And so when it comes to a couple, filing jointly typically is better than filing separately. Almost always better off. But there are certain credits and deductions that are not available to you if you file separately, like the earned income credit, for example.
You file jointly.
If they're not eligible to you, they're not eligible if you file separately.
If you file
separately. They're available to you if you file jointly, but not available to you if you file separately.
Right.
Which, right off the bat, that is a huge consideration, right? Like the earned income credit, dependent care credit we talked about earlier, tuition credits, student loan interest deduction, not available to individuals, couples who are filing separately, and hope and lifetime learning credits, the old college tuition credit.
Let me parse this. These married couples filing separately, a divorced couple cannot file jointly, can they?
If you are divorced, if your status is divorced at the end of the year, you do not file jointly. You have to file separately or head of household.
Right. Yeah.
So, but if you're like Massachusetts, for example, there's a period of time,
90 days.
Is it 90 days where you can change your mind?
Yeah.
And stay married. I don't know how often that's
I'd love to know the analytics on that. I would really love to know the numbers on that. That's going to be my week this week. I'm going to try to find that out.
Try to find out how many.
No, but you're talking about the tuition tax credit. You can't do it if you're filing separately, but a divorce.
I don't want to clarify.
Yeah.
So if your status is married at the end of the year, you can file jointly, or you can file married filing separately. Right. So even though you're divorced on January 1st, if you're still married on December 31st, then you're not filing single. Right. You're filing either jointly or separately. Gotcha. Right. Yeah. So, but there are some reasons, and I don't know. Can we pull up the pull up the slide? So there are some reasons why you might want to file separately. One is the alternative minimum tax. Alternative minimum tax, for those of you who don't know what it is, it was started in the 1970s. It was only supposed to affect the most wealthy of Americans, but
make sure those people pay their taxes.
They never exactly. Yeah. Right. They were just taking too great an advantage of the tax code and not paying any taxes. So they said, hey, you have to pay a minimum amount, and so they set an income threshold that they never changed. And eventually people caught up with that, and then it started to affect a lot more people. In the last round of tax reform, they did increase those numbers, but is still there and potentially could affect your income taxes. So the alternative minimum tax is a reason why you might want to file separately. Why? Because the one or other spouse may actually fall below those income thresholds and not be subject to the AMT, because the AMT is a flat tax. They get rid of certain deductions, right. And so the tax is higher. In fact, what you have to do every year is you have to calculate which of those taxes is the greater.
I see. And
you have to pay the higher amount, right? So that's one reason why you might want to consider filing separately. Another reason why you might want to consider filing separately is that certain itemized deductions, like medical expenses, for example, are subject to a threshold, an income threshold, before you can actually start to deduct those expenses. 7.5% of your adjusted gross income is the threshold before those medical expenses kick in. Things like fertility treatments would be a deductible medical expense. But unless you get over a certain threshold, you can't deduct it, or the amount that you can deduct is subject to that threshold. So you don't deduct $1 until you've exceeded that 7.5% of adjusted gross income. So $100,000, $7,500. So until you have $7,600 of medical expenses, you can't deduct it, and only the $100,
Yeah.
the amount over,
Yeah.
becomes deductible. So if one of those spouses who's incurring the medical expenses has a lower income, that threshold is lower, and suddenly you can take greater advantage of those itemized deductions,
Mhm.
right?
So if you've had an interesting year medically, this might be one thing to consider.
And by the way, the IRS confirmed that your personal protective equipment that you buy, your masks, are considered a deductible medical expense for 2020.
We're spending 7% of their income on masks.
Well, if you know, on top of if you already
I understand.
if you already have high medical expenses, and you're yeah. So they're not getting rid of the threshold. They're just saying that
Rather
it qualifies.
thin margin right there, but yeah.
It qualifies. I saw the it was big news on the IRS's site. What? Yeah.
Your PPE is deductible.
PPP is deductible. Yeah,
Yay.
exactly.
Yeah.
Hey, another reason why you might want to consider filing separately is that, hey, filing separately, and I've done this quite a few times in Massachusetts, where it actually makes more sense for the spouses, because the rules are a lot simpler than they are, and the exemptions, adjustments, deductions, that sort of thing, are not as many at the state level. Separating your income tax returns actually can be beneficial. Some states require that if you file separately at the state level,
Yeah,
you
that's
have to file separately at the federal level.
yeah, because I'm that guy. That was my question.
Yeah, yeah. So you can't pick and choose in a lot of states. So again, maybe it doesn't make sense at the federal level, but it does at the state level, and there's a significant decrease, or significant enough decrease at the state level to offset the higher tax at the federal level. So it might be a better solution for you to file separately under those circumstances. Another reason, and this is, I think, an important reason, is if you're separated or you're getting divorced.
Yeah.
So when you file jointly, you are jointly and severably responsible for the income tax liability.
Yeah.
So let's say that your spouse distributed money out of an IRA account, use that money to buy a boat.
Yeah. Happens.
Does happen.
Yep.
Um,
Separated, you need a place to live.
that IRA account was not in joint name.
Yep.
The other spouse has no idea that it occurred. And the 1099 goes to whom? Goes to the person who did the distribution. If that person decides that for whatever reason they don't want to disclose that to the other spouse,
Yep.
they might want to keep it off the income tax return, right?
Yeah.
And file the income tax return without the 1099. So the IRS is not dumb. They they get copies of all these 1099s and they compare them to what you actually filed.
Yep.
And if you took out $100,000 out of your IRA and you didn't put it on your income tax return, guess what? They're going to send you a notice and say, "Hey, you owe us some more money."
Hey, you
If
missed this.
If you missed this, yeah, you forgot.
You forgot.
You forgot to put this on the tax
Just
return.
a friendly reminder.
So if that happens, and you're the spouse who filed jointly, guess what? Even though you're divorced, living your separate lives,
Living your best life.
happily living your separate life,
Yep.
they're going to send a notice. That little notice that said, "Hey, you might have forgot this." They send one to each taxpayer. They look exactly the same, different name on it.
Yep.
And guess what? You are responsible, not for half. You're responsible for the entire amount.
Wow. Both of you are
Both of you are
responsible for the entire amount.
Right. And when the IRS wants to get their money, they're going to go after whoever has that money and use whatever leverage they have in order to make that happen. So when you're in that situation, you're separated, you're getting divorced. My recommendation typically is to separate your finances as soon as possible, including your income tax returns. Now, here's the thing. You can always amend your tax return from filing separately to filing jointly.
Mm-hmm.
You have the same amount of time, 3 years from the due date of the return to make that amendment. You can't do it the other way. Once that joint return is filed, that's it. There's no separating them later on.
Interesting.
The only relief that's available to that innocent spouse is exactly that, what they call innocent spouse relief, where you file a form and you say, I had no idea.
Yeah.
I had no idea that this money was dispersed. I didn't benefit from it. I never saw it. And I obviously didn't know that it was supposed to be on the tax return. But to avoid all of that, just file.
That doesn't sound like a fun time.
Just file separately. Now, I have learned that the law with regard to filing tax returns in a divorce proceeding is that if you're filing your tax return and it's causing the joint financial situation of the spouses to be impacted negatively, that you could actually become personally responsible for the difference. So that difference in the joint versus, you could actually become. But again, you can always fix that by amendment.
Yep.
Yeah, absolutely. Right.
Plus, it's good leverage discovery for the divorce proceeding. Tax return for a separate tax return for that year.
Yeah. Yeah. I thought you were going to say something else, but what actually might put pressure on the other spouse to
disclose.
Yeah, to disclose,
because the penalties are larger than and more.
Well, if you're the one that's filing separately, and by the way, your spouse cannot file jointly unless you agree to it, because both, and this has become a problem with electronic filing, because a lot of in a lot of marital situations, one of the spouses was the person who was filing the income tax return.
Really?
And well, you don't actually have to have somebody sign it. You can just say that, yes, they agreed.
You know, we give the IRS a bad rap, but they got a lot to deal with. They got a lot to deal with.
Having sympathy for the IRS.
I'm feeling a little bit of sympathy for the IRS. Yes, I am.
Hey, in the
if you're listening, I hope that goes on my record.
the fifth way.
Yes.
Or the fifth reason why you might want to consider filing separately: student loan forgiveness.
Oh.
So you're one of those individuals who took out some student loans.
Mm-hmm.
You're graduated from college, and you're working in a qualified sector, a qualified employer, nonprofit, government agency, that sort of thing.
Right.
And you're making less money, and with the hopes of having your student loans forgiven at the end of a certain time period.
And there are provisions for that.
And there are,
federal student loans.
Correct.
Yep.
Right. But your payments while you are working towards
forgiveness,
right? Your minimum payment is all based on your income, right? So they adjust the payments,
right,
to be consistent with the amount of income that you're making. And if you file a joint return, they base those payments on the adjusted gross income of the couple.
Interesting.
But if you file a separate return, legitimately, they base it on just the AGI of the individual borrower as opposed to the household income. So the individual income versus the household income, which reduces the amount of payments that you have to make, and the length of time to get forgiveness is specified. And so what ends up happening is you could end up paying a lot less towards that loan, and the principal at the end of that time period would be higher than if it was based on the household income. Right. And so a much greater amount of your loan is forgiven under those circumstances.
Wow.
Strategic reason why you would want to file
interesting for young couples
instead of jointly. Yeah. In most cases, it doesn't make a lot of sense, because you end up paying more in taxes at the federal level. But there are certain circumstances, certain situations where it would make sense to file separately. The only way to know for sure is to do a comparison. So you complete the return as a joint filer, and then you do a what if. What if we filed separately? What does that look like? Now, for individuals who are trying to do that themselves, it's not always an easy thing to do, but it is something that we can do for our clients routinely. We do that for our clients just to give them an idea of what makes sense to file separately, if it makes sense to file separately. And it's not too late to decide to file your income tax return yourself. Let's say you put it off pending some of these changes and you're looking to do it yourself. Again, I want to mention that there is I think, a very competitive and comprehensive option for you, other than some of the ones that you've been seeing advertised over the last month or so. And it's one flat fee, $25. A lot of these other firms, they advertise it's free to file, and they get you when you try to file the state return, or it turns out that if you have any capital gains or dividends or something like that from investments, then suddenly there's going to be a fee to file either federal or state. But this is one flat fee, $25, and it includes everything, including Schedule C. So if you routinely file a Schedule C as a self-employed individual, those other guys aren't going to let you do it for free. Right. This particular system does allow you to do it for free, and you can go to our website. It's AndoverAdvisoryGroup.com. There is a link there to get to the site and start filing your return. You do it. You start it for free. You don't actually pay until such times as you're ready to file. Or you can use this full code. You can just take your phone and hover over it.
Hold it up there.
And you can start filing your tax return for 2020 if you've waited this long.
Could not be easier. Yeah. Hey, so I also want to. I have this week's Talk Money tip. It's on homeowners insurance. Oh, okay.
Yeah. So let's take a break.
All right.
When we come back, I got the Talk Money tip for the week.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Welcome back. Hey, Lou,
Yes.
you didn't mention anything about my badge.
I didn't see a badge.
You see my badge?
No. I can't see it. It's behind the mic.
Oh, is it?
Yep.
Is that better?
I can't
Can
see
we get a close up? Can you get a close up of the
Can't get a
badge?
close up. What does it say?
It says I got vaccinated.
Oh, okay. Second shot?
No,
No.
first one.
Which one?
Moderna.
Yeah.
Moderna, yeah. 2-shot.
When did it happen?
St. Patty's Day.
Oh, I know. What was your reaction? How was your reaction?
Just soreness around the injection site for 24 hours or so. That was it.
I can't get an appointment within 100 miles of me.
Is that right?
Yeah.
Come to New Hampshire.
Can
I'm
I?
serious. Why not?
Because
Call
I'm
him.
not in New Hampshire.
I don't care. I don't think it matters.
Oh, okay.
Call him.
I'll give it a shot.
Yeah. People are getting emails. They're reaching out to
I've got shots.
yeah.
So who's doing the shots? Like CVS's and Walgreens, like in Massachusetts?
So it was in my situation. It was a company that has a vaccine program, and so they friends and family.
I see. Yep.
So was able to take advantage of that. Otherwise, I'd be waiting until
I got thrown an appointment.
May.
I got thrown an appointment by friends and family type of thing about 3 days before I was eligible.
Oh yeah.
I only became eligible on the 4th, I think.
Yeah.
Or the 29th, I think I became eligible.
So check out New Hampshire and see if you can. 'Cause I know people in New Hampshire that are going to Massachusetts and vice versa.
Oh, really? Okay.
Yeah,
Good.
I don't think you have to be a New Hampshire resident as long as you're in that cohort that qualifies.
Okay, great.
So, yeah.
See, New Hampshire's doing such stuff for us here in Massachusetts, and it's like we're giving them such a hard time. We can't travel there. We're taxing them when they work
Yeah,
there.
I don't know what the status is of the work at home.
Yeah.
Controversy, whether or not your income. Well, Massachusetts is pretty clear on it. If you're working from home and you live in New Hampshire, and your company typically you were being taxed on the income from a Massachusetts company, Massachusetts has taken the position that that's still taxable, even though you were working from home, because this was not a permanent situation. It was just a temporary situation. And so the state of New Hampshire filed a lawsuit and went to the Supreme Court, U.S. Supreme Court, as I understand. And there's haven't heard anything about it lately. I don't know if the state of New Hampshire has any standing in that particular case or whether or not they'll prevail. But stay tuned. There might be a change to that rule as well. Hey, so today's Talk Money tip is all about your homeowner's insurance policy and how the insurance company pays in the event of a loss. And there's a couple of ways they can do that. One is replacement cost, which is the most is the amount that's needed to replace or rebuild your property or repair damages using similar materials to what you had before. There's usually a maximum dollar amount, but that's one method of paying the claim.
Right.
The other is actual cash value. So actual cash value is today's replacement cost less depreciation. So if you've got a house that's 20 years old, well, they can give you an amount that's equal to actual cash value, and it's up to the insurance company unless you make sure that you have an endorsement on your policy that says that they have to use replacement cost. So look at your insurance policy, see if you have that endorsement. Now, this applies to the structure itself. It also applies to your personal belongings. Personal belongings is the area where people are mostly disappointed when they find out that your 10-year-old couch is really worthless.
Yeah.
and so they
everything's depreciated.
Because everything has depreciated in value. Yes. I said worthless. I was exaggerating, but you're not going to be able to.
Not by much.
You're not going to be able
Yeah.
to go out and go to the store and replace all that stuff for the amount of money that they're willing to give to you, because they have the option of actually buying it, replacing it if they want to, or just giving you the cash. And what's the insurance company is going to choose that option that's going to benefit
Lowest
them,
payout,
right? The
yeah.
lowest payout.
Mhm.
And so you have the ability to put an endorsement on your insurance policy that obligates the insurance company to pay you actual replacement costs or replace the item, one or the other.
Yeah.
With this comes something that I think you have to pay attention to, and that's inflation, because these replacement cost endorsements typically come with an inflation clause that will automatically increase the amount of coverage that you have to offset inflation, because if they're going to be on the hook for replacement costs,
Sure.
inflation is going to increase the replacement cost, and they want to make sure they're getting the appropriate premium for that, right? Well, what's happened is over the years, these inflation endorsements have increased the amount of coverage that you have to an amount that's actually exceeds the actual replacement cost of the home.
Because
So-
the inflation clause, I'm guessing, is more than actual inflation.
It has been increasing at a rate that's greater than inflation. So what you end up is with this high premium that you don't have to pay, even though you have this replacement cost endorsement. And what you need to do is you need to talk to your agent, have them run a replacement cost analysis on your home, and determine if the amount of coverage you have is in excess of what you actually need in order to have that coverage.
So in essence, reset your replacement cost coverage.
Reset your
Reset the
replacement
price on the.
reset the value
Yeah.
reset the amount of coverage consistent with today's replacement cost, and that could save you a lot of money in insurance premiums.
Yeah, I can imagine. Yeah.
It can be and insurance companies love it because they have this automatic increase in your premium every year,
Yes.
right?
Yep.
And then
It's inflation. Nothing I can do.
you're paying the premium for a few years, and you open up the bill and you say, "What? How much? I thought it was a lot lower than
That
this."
couch isn't worth that much.
It's not so much the count. In this particular case, everything is predicated on the amount of primary coverage you have on the house itself,
Mhm.
and so everything goes up along with that. All the coverages go up accordingly, and so it's really the replacement cost on the house is your focus
Right.
when you're trying to determine whether or not you have the right amount of coverage. Now, I'm not saying decrease it. If the replacement cost is consistent, then you just leave it alone.
Right.
But for a lot of people, if you've had a policy for 4 or 5 years and you haven't looked at it, it's very likely that the replacement cost has gone up significantly,
Yeah.
and is higher than what your actual replacement cost, or the amount of coverage has gone up at a faster pace than the actual increase in the replacement cost of your property.
And they will not pay out the extra in costs. They will.
They do
replace it.
not.
No.
Oh, no. If your coverage is here and they determine that your loss is
Right.
here, they're going to pay you this.
Right.
Right.
Yep.
Correct. All right. So that's today's show. Thanks for tuning in today. I really appreciate you being here. I should mention that if you want to get in touch with me after the show, please use the toll-free number, 877-475-2062. You can send me an email. It's jeff@talkmoneyradio.com. Or you can just send us a message right on Facebook. Take advantage of that initial no obligation consultation. We are still having meetings via Zoom, if you like. If you're still hesitant to come in, I have got my first
You're vaccinated.
my
so you're
first
good.
shot, so it's a lot lot safer at
Well,
the
you're half
office than
good.
it used to be.
Yeah. Well, you're not quite half as good. I don't know what is Moderna, 40% good or.
I
35% good.
don't know the efficacy on the first shot, but all indications are that even the first shot of the vaccine is 100% effective against dying from COVID.
No one has died.
No one has died because that has been vaccinated with the first
Okay.
dose.
I guess that's something.
Yeah, and hospitalizations significantly declined, and they're saying that it's almost 100% effective against hospitalizations once you get the second dose. And the number of people who have been inoculated has it's in the millions at this.
It's significant.
Yeah, they hit what they're going to hit 100 million, and now the president wants to set a new target of 200 million at the end of his first 100 days. So looks like we're getting there.
Yep.
Yeah.
We're almost back to normal.
Almost back to normal. Hey, thanks for tuning in. We'll be back next week. Remember, in the meantime, good sound advice is much better than advice that just sounds good. Thanks, Lou.